Hello, I'm Brian Zen. I teach investment analysis at St. John's University. I also manage money for private and institutional clients with a New York investment firm. I earned an MBA in accounting, a PhD in finance, and I passed all the 3 CFA exams. In this study session, we talk about valuation issues of debt investments. There are 3 risks that we all have to be aware. First is the default risk, and then we have the credit spread risk. We also have the downgrade risk. Default risk is essentially the risk that the borrower will not be able or not willing to pay the debt, and they just don't pay, and you have to sue them in bankruptcy court. The credit spread risk is the risk that the debt valuation or the bond price drops. And let's say if the government bond is paying you 5%, and this bond from IBM is paying you 8%, and for some reason people are worried whether IBM's business is deteriorating or not, and the bond price goes down, and the bond is yielding you 9%. The spread increased, the bond prices went down, and that's your credit spread risk. Lastly, we have the downgrade risk. Downgrade risk is essentially what if Moody's and S&P downgrade your bond and your bond price drops, the spread go up, and that's your downgrade risk. There are 4 C's we have to consider when we are analyzing the quality of a debt security. Number 1 is character. This includes the management character and the commitment. They will pay the debt that they borrowed. Essentially, it's the management's integrity. If somebody keeps their promises, they borrow $10 million from you, and they will be committed to paying you back, that would be a good character, and you should value the debt more than the others. The business qualifications of the management is very important, and their past operating records are also important factors when you evaluate the character of the bond security. The second C that you should consider is capacity. Is the company who borrowed money from you, do they have enough cash? Do they have enough earnings power? Do they have enough assets or liquid assets or hard assets to eventually pay you back? So capacity is an important evaluation factor. Collateral is also important. You, as the creditor, you can request the company to put up securities with you, put up hard assets up as collateral, such as a warehouse or the factory building. Those collaterals, the quality of those collaterals, the stability of value of those collaterals are important factors to consider. Lastly, we have covenants. Essentially, these are the terms and conditions of your debt agreement. Sometimes you can place limitations on management decisions. You can say, okay, I'm lending you $10 million, and therefore I restrict you to borrow more money. I restrict you to borrow more than 30% of your total asset. And these limitations on the operating management would be the covenants. And these you put on your lending agreement. The analysis of the above 4 C's are very important. And let me repeat those. Essentially, their character of the management, the capacity of the company's ability to pay debt, the collateral that put up to borrow those debt, and the covenants in the lending agreement that protect you as the bondholders. We can look at a couple of ratios that are calculated from a company's financial statements, and you use those ratios to assess the quality of the company's bond or debt. The first ratio are very familiar to all of us. That's the current ratio. To calculate the current ratio, you use the current asset, the first couple of items from the company's balance sheet, and you divide current asset by current liability, the first few items that's listed on the liability side of the balance sheet. The next ratio that is more strict than the current ratio is the asset test ratio. Another name for asset test ratio is the quick ratio. Quick ratio essentially is they ignore the inventory, but it's okay to consider the value of the accounts receivable. So essentially, you start from the first item of the balance sheet, and that's cash. You add on to cash your marketable securities, and then you further add on your accounts receivable. Those would be what you consider as assets that you can quickly convert to cash. Those quick cash assets or similar cash equivalent quick assets divided by current liability would be your quick ratio. Another way to do the calculation is to starting from the total current asset. Starting from the total current asset, you take out inventory. You also, because inventories are sitting in your warehouse and you don't know how valuable they are, you also take out accruals. For example, your deferred tax assets. Those cannot be converted into cash. The IRS is not going to send you a check. They will wait for your next year or future years' tax returns for you to reduce your tax liability using those deferred tax assets. So those deferred tax assets cannot be converted into cash. These accruals must be taken out of the current asset. And then you have to take out prepaid expenses. Those are the expenses that you have already paid for the next 12-month rent. You cannot convert those into cash. From those two issues, you know you want as much cash as possible sitting on the company's balance sheet. You want the company has lots of marketable securities. You don't want them to have too much inventory, and you want them to have some accounts receivable, assuming all their clients are in good credit standing. Next, we look at some more issues about how much the company has borrowed. What is their debt load? We first look at the long-term debt to total capital ratio. To calculate that ratio, you start with the long-term debt. You get that number from the company's balance sheet. You divide long-term debt by the sum of long-term debt plus equity. That would give you a sense of how much long-term debt that this company was involved in. Then you can calculate the total debt to total capital ratio of this company. And to calculate this ratio, you use the current liability plus long-term liability. That is long-term debt. The sum of that is on the numerator, and you divide that by the sum of long-term debt plus equity. That would give you a sense of how much the company get into in terms of total borrowing. You don't want the company to be borrowing too much long-term debt. You don't want the company to have too much long-term and current debt. Next, we look at two coverage ratios. We see how much earnings before interest and taxes, or EBITDA, how much of that can cover the interest expenses that the company has to pay out